Hi, all. Welcome back. Now we're going to actually go over credit performance attribution. Uh, in our view, highly topical, and we're going to specifically think about credit risky corporate bonds in related areas. For that, I have with me Artur Sepp, and I would like him to introduce himself.
Hello, everyone. Welcome to our panel. Artur Sepp. I am head of Quants at LGT. I have background in investment banking and private banking, as well as in hedge funds, in being front office quant trader, and quant developer. So my area of specialty focuses on everything from linear products to non-linear, including rates, credit, and bonds. So why I'm very happy to be here and contribute to the event.
Perfect. I think in many ways he's the perfect person to take us over what I think is an emerging and very interesting and challenging area of focus, if you will, for investors. So with no further ado, let us dive into our area of credit performance attribution. And Artur, if you could tell us a little bit, if you could spend a minute or so outlining, the area we're going to focus and why we're focusing on this area, if you will.
Of course. So credit corporate bonds market is one of the probably biggest asset classes, and investors are attracted because it promises fixed return. Of course, in finance, nothing is fixed until you get your money back. Dependent on the credit quality, you may have, say, smaller compensation for risk, or higher compensation for risk, like high yield, where you have sizable market beta, especially in downside scenarios. And of course, credit can, it's a significant, like it allows to a significant portion of strategic and tactical asset allocation, and it's a must-be investment for broad portfolios.
Given the fact that it's sort of ubiquitous asset class, if you will, corporate bonds are everywhere. It's a broad theme for issuers and a broad theme for investors. What are the art of the possible? What are the different frameworks? What are the sort of approaches, measures? Just sort of a broad brush, so that as we dive in, it sort of provides context to our discussion as we go along.
So model-wise, so in a classical quant framework, when we have to price a corporate bond, right? First, typically industries does using two factors, but then we also understand what are the factors and how we attribute the performance on bond to these factors. First factor is always government term structure of government rates, right? Each this is a key input, because in the end, credit, the second input is credit spread, and it's added. It's always the valuation work that first layer is how much you can get on the government bond, because government bonds, say for G7, it's considered risk-free. Then how much spread you can add to take extra corporate risk, right? So the second component is credit risk, and typically this is like, you can think this is some sort of mean reversion processes, right? The term structure is mean reversion, like rates always fluctuate around some level, credit fluctuates, they're positively correlated, right? Sorry, negatively correlated. Usually lower rates means economy is worsening, and therefore credit quality deteriorates. So, and credit is typically calibrated to CDS market. CDS market for most of the liquid credit names, issuers, is more liquid than underlying cash bond market. So therefore, usually the first layer to calibrate to rates, to government bonds. Second, calibrate to CDS. And then for each specific issue, there's always some liquidity effects, like maybe due to typically corporate bonds are callable, meaning that if rates decline, the issuer has the right to issue or buy back the bond at higher rate, which say pays higher coupon and issue a new one. So there's always this size, can be different sizes. So always liquidity. And therefore, if we talk of contribution, the first is always like what happened to level of government interest rate. Second, what happened to the issuer specific credit worthiness measured by CDS changes. And third is what happened to bond, specifically to bond, to this particular issue.
So in terms of factor models, how the 2-3 dimensions to factor models in many ways. So these are the core factors that you're looking at. How have these factor models, how have these and any other factor models performed over time? How has this asset class performed? What are the numerical perspectives that we can think about over the last year, couple of years, whatever?
Mm-hmm. So now when we talk of factors, so we said that the price itself is driven, say, by macro drivers, which is, say, the most that is interesting for credit investors is a corporate spread, overall corporate spread that you can trade through CDS. Now, what drives this corporate spread? So first question, of course, it's macro driven, right? That is, if say economy is growing, right, that there's better, it's just fundamentals of the company is better. So they can either repay or pay back or reissue. So therefore credit improves. Then there is also what is called factor framework, where there are drivers of specific to, say, the company, right? So most typical is being quality. Quality factor is being a balance sheet. Of course, it's a first of all the balance sheet. how debt, how much debt, what is the coverage of debt by current say earnings. Then liquidity also, like a balance sheet. If they need to roll or they can just cancel existing obligations. Then there is also behavioral. Usually it's a value factor. Value, of course, in many definitions. Usually, if you buy like a high spreads and sell low spreads, usually that's the most typical. Momentum both on credit spread, that usually, because these processes are autocorrelated, if spreads improves, you expect it to continue to improve. What is also a significant factor is performance of the equity, especially for high yield, for more leveraged corporations, because in the end, it's always possibility that you can roll, like you can either roll the bonds if you have normal like equity fundamentals, or you issue new stocks, right? Even though the so-called modular Miller theorem tells that actually the way you finance the company does not depend on your costs, right? But it's, of course, it's in practice it's not true. One is also carry, and carry also kind of expected risk-adjusted carry. So not only the yield to maturity, but you also incorporate some sort of probability of default, right? It's more like scenario-based analysis, where say you consider total return, and of course for bonds there is possibility you default, right? And there's also like how much you can generate from the say recovery rate. And I think that's all. That's the most, as I said. So it's momentum, value, quality, carry.
Now, clearly, once you structure your factor model, you have got many ways to sort of build the attribution analytics from there and figure out how each factor contributes to the total return. But there are quite a lot of challenges around the credit risky bond space, if you will. Liquidity is a central dimension. The quality of data is a central dimension. Not all of this stuff gets traded. I mean, many bonds go without trading for a long period of time. And so when we are thinking about momentum, well, this is not much momentum. It's just been sitting there for a long time. And so how do you account for these structural issues, data specifically, then the fact that individual securities don't have liquidity, and um, putting all the securities on a single curve can, even from a single issuer, can often be a challenge. They don't know. You find it hard to often align all of them into a single curve. So, how do you address these, and what do you think are the sort of overarching challenges as we sort of handle the credit attribution analytics, if you will?
Well, these are indeed that data. It's not only quality, but it's true. It's not some of the issues are not frequently traded. Then of course it must be somehow backfilled. As you said, the most straightforward way is to build a curve for the issue, right? As I said from beginning, you try to build it using very liquid CDS, usually CDS of very liquid issues, right? And then of course you have a curve, and each issue has like a different dependent on maturity. It's like almost you can think of ordinary least squares, right? There's always some residual error. And then of course most of these factors you can define on say on a fixed inner, like say 5-year or 10-year, right? And then they're just model the how this kind of 5-year or 10-year rate evolves for each bond. We know the duration. That's why, of course, it's very important. As I mentioned, the bond pricing must be like in how if you usually people would do, you either go for a vendor and you trust him, right? Data vendor and also risk kind of risk solutions, right? That I will not name the names, but usually it's what you do, and then most of them have or the top ones have very sound methodologies, and usually it's just extrapolating the kind of curve movements into specific bonds movements. And of course there's a lot of noise, I agree, but it's what finance, it's very
I agree. I mean,
world.
this is I mean, the infrastructure for all of this, as you said, rightly, is improving. The valuation services are getting much better. They're covering much broader pool of securities, and so their coverage is getting better. The risk systems are getting better. They're able to incorporate broader set of assumptions, but it still remains a relatively hard problem. I mean, the liquidity issues are not going away, and the need to ensure the correct curve building and all of that is not going away. So I'm sure we will be having some of these conversations in a couple of years' time as well. So with that, thank you very much for little shedding a little light on a fast emerging and growing area where with a lot of interesting challenges of its own. Thank you very much.
Thank you, Sid, and thank you, listeners. And I wish you the rest of good day and enjoy the rest of the conference.
Thank you.